So, okay, it's a great pleasure to meet Richard Flax, who's the CIO of Moneyfarm. So what I wanted to do today was to get a little bit of insight into how you allocate your capital, how you keep your fees so low, because I've invested my own money in your fund, so I'm very keen to know this. I had a great experience with the onboarding. The site was incredibly slick, it was very easy, the questionnaire was simple. But what I'd like to do is kind of look under the hood. So maybe we could start with what really motivated you to create the company in the first place. So what is the kind of ethos behind Moneyfarm?
Well, thank you very much. So the ethos, I think, when the founders created Moneyfarm, and that's true to this day, is to be able to provide a very strong, compelling and robust asset allocation at a very competitive fee. The starting perspective was that the fees that retail investors were being charged were high, and that through technology there was the opportunity to bring those fees down in a scalable and ultimately profitable way.
So these fees, I really couldn't believe it when I saw that under 10k you don't charge a fee at all. So I was very careful not to go over the 10k limit initially while I was trying it out. But how do you keep the costs so low?
Look, I think that when we think about the customer, clearly what we want is for customers to grow with us over time, so that the customer is attracted perhaps initially by the website, by the fee structure, but that over time that they and we will grow together in terms of building up their wealth over time, and so you will begin to be well above the £10,000 minimum. And we have some evidence to support that from our experience in Italy, where as a company we've been operating for much longer.
Okay. And in terms of the asset allocation process, what I was very keen to find out was, how do you approach it? Because a robo fund, there are two ways it could be robo. One is matching the questionnaire to the portfolio with a suitable risk profile. And the other way is actually managing the money with an algorithm. So some of the companies like Nutmeg, there's an asset allocation team which does the actual investment process. Whereas Scalable Capital, it has an algorithm. So where do you sit on that continuum?
So we broadly speaking, in the first of those two camps, we have a quantitative process in the sense that we run a strategic asset allocation once a year to give ourselves an expected return and risk profile for a range of asset classes. That underpins our asset allocation. From there, we have a tactical overlay that is driven by the investment committee, which is made up of the asset allocation team, our chairman and our CEO. We meet every 2 weeks, and we have boundaries within which we can operate in terms of looking tactically at markets and seeing if there are opportunities. Again, bear in mind the strategic asset allocation is a multi-year allocation, so the exact path by which you get from here to there is not necessarily going to be a smooth one. And that human overlay gives you some element of control and importantly accountability for the decisions that we make.
So just to explain for people who aren't familiar with strategic and tactical, strategic is your kind of long-term view about how markets are going to operate. So
yes.
You have to have a view about which assets will give you the best return over the long term.
Yes. And
then tactical is your kind of short-term strategy, which has to be very nimble.
Yes. Exactly. The only point that I would add to that is that tactical is not, when we think of shorter term, we're talking 3, 6, 9 months, not 3 days, 3 weeks. So the whole kind of premise of the offering is that clients and ourselves should be thinking about building their wealth over the longer term, which we mean a multi-year period. So thinking about the return of any single year, we would argue is not the right way forward. And again, when you think about our fee structure and the advantage that a client gets from having very low fees, they realise that most clearly if they invest with us over a multi-year period, because you have the effect of compounding those fees. So every year you're getting an additional benefit, and as that the longer you do that for, the greater the benefit is over time.
Okay, so you're really trying to entice people to invest with a long-term horizon. Ultimately, they have to trust you as a money manager because it's your decisions which drive the returns on those funds. But one of the questions I have is, how do you, because you have multiple funds with different risks, how do you decide on the allocation for each of those funds? Is it quantitative, or is it a human which decides?
So when, for the strategic asset allocation, you're going to come up with a set of expected returns, predominantly quantitatively, for a range of asset classes, and that will give you can optimize that, and that will give you a portfolio. And then you have the human element, which is the overlay, which is effectively tilting in certain cases where you think, this may be true over the long term, but in the meantime, we think that there's an opportunity somewhere else. But to your point around risk, yes, our clients are in one of 6 different risk buckets. We measure risk in a variety of ways, be it volatility, be it drawdown, and we build portfolios that are consistent with those risk targets. There are obviously a number of different, there are those guardrails, but there is obviously discretion within that, because you have a range of assets and you can get to a particular risk target in a variety of different ways. And that it depends on where you see opportunities or risks in particular asset classes. So you've got these fairly defined guardrails in terms of what we're going to be providing to clients based on their risk profile. But within that, there are a range of tools that you can use to get you where you want to be.
Okay, I talk about volatility a lot because I think a lot of people don't understand it, but it's so important when we come to invest. So if we could maybe move on to markets now, it's a nice segue into risk. The volatility index in the United States, the VIX index, which has a kind of 1 month horizon that it looks ahead in terms of volatility, currently it's crashed, so it's below 11. So in that kind of environment, do you think that's complacency, given the valuation of US stocks is very high?
It's an interesting and it's an important question. It's one that we talk about a lot, because clearly if you're targeting different levels of risk, risk is not as stable as, those measures of risk are not as stable as you would like them to be. Is it low versus history? Yes, it appears to be very low versus history. What does that mean for portfolios? One of the things that it means is that we have to have a debate around, how hard do we need to try to target a particular risk level? Is that appropriate? And one of the things that the investment committee does in terms of that thinking about that human interaction is not just to look at the historical implications, but think about the future implications and say, well, what is truly appropriate for our clients? So when you if you look at our portfolios across the board, the realized volatility of those portfolios is probably a little bit below target over the last 3 or 6 months.
Okay.
Now, we effectively have said it's, trying to get to very high levels of volatility, relatively high levels of volatility is not entirely prudent, given where realized volatility is in the world, and we need to reflect that. And we do that because we think that's in the best interests of our clients. But it is, it's something that we think a lot about, that we worry about in terms of thinking about what might cause, a regime shift to one degree or another in terms of volatility normalizing. And we think that we've made a conscious decision, I would say, to consider that when we think about the asset allocation that we provide across the board.
I think it's cool that you have the human element. So when vol does crash, you don't slavishly just dial up the risk. I think that's great.
No, I mean, look, the accountability is very clear. Right? It sits with us.
No, that's good to know. Reassuring for me as an investor. So in terms of how markets look at the moment, or at least the global economy looks at the moment, in developed markets, you've got growth of about 2%. Everyone was cheering that Europe is above 2%, but it's just as fast as snail in a kind of snail race. Whereas emerging markets, you've got China still around 6%, India above that. So long term, do you see value in emerging markets at the moment?
So I would say the short answer is we do see value in emerging markets. We don't have a very aggressive position in emerging markets, but we think it's appropriate that you should have emerging markets in a diversified portfolio. There are a couple of drivers behind this. One is, as you mentioned, that while GDP growth may not be as robust as it was in previous decades, it has certainly improved, and it is a bit more synchronous than maybe it has been in recent years, and so you have more parts of the global economy doing a little bit better, and that is positive particularly I would argue for equities, depending on the starting valuation, but also positive for emerging markets. So when you think about emerging, since you asked about it, I mean, a couple of interesting points. The first is the impact of better global growth. The second is that the starting valuation is not bad. It's not extremely cheap versus history, but it's not bad, and it looks relatively attractive compared to some other parts of the equity universe. And I think the third part is one about market expectations, where if you look at consensus earnings, for instance, that historically have started at quite a high level and steadily been downgraded over the course of the year, every year, not just in emerging markets, but more broadly as well. So far this year, at least, those expectations have held up maybe a little bit better than they did in the past, and has historically been an important underpinning for equities generally and for emerging markets more specifically.
It's funny, in the end, every year it would start at 12% earnings growth every year, and then it would just plummet every year.
Yeah.
To about 3%.
No, look, I mean, and it was, that has been the case for the last 5 years. But the evidence seems to suggest that maybe those starting expectations are now a bit lower and maybe a bit more realistic and a bit more achievable.
But trade is picking up. The wheels haven't fallen off the bus from China.
No, that's
so that's
true.
quite positive.
Yeah.
They seem to be delevering their economy. A massive enterprise, but they seem to be doing that rather well.
Policy making there is as everywhere is a challenge. They have managed to kind of prove the doomsayers wrong repeatedly in recent years, and hopefully that will continue to be the case. But again, there too, starting valuations around for large swathes of that market are reflect the challenges.
Which bit of the end do you think you like best?
We haven't taken a kind of a strong regional view in EM. One of the benefits of EM is that it is still if anything a more diversified asset class now than it was maybe historically in terms of on a sector component, but it still has meaningful exposure to cyclicality, to stronger growth, even if it's weightings in traditional cyclicals like energy and materials is lower than it once was.
And in terms of demographics, is that something you think about? Because if you do look over the long term, as the global population ages, you'd expect lower returns over the long term. So whereas in the past we saw, 6, 7, 8% growth in equity markets as earnings grew at 8%, as the population ages, I guess, what we'll see is a slower growth in earnings and GDP, but also lower interest rates over the long term. So is that a challenge you think about?
Look, I think that there's a general challenge, and that's one of the components. The general challenge is for a variety of reasons. Expected return, you have to think that expected returns looking forward from where we are today will be lower than they have been in the last 15 or 20 years. Right? So we need to think about that. That has a variety of implications for savers, for governments, and it's a challenge that clearly we're trying to solve. Now, where does it work for us? Clearly, in a low fee world, if your expected gross returns are not going to be as high as they once were, the relative impact of the fee becomes even more significant, right? So the benefit that you gain from having relatively lower fees should rise. The demographic side of it is an interesting one. I mean, you kind of neatly position the two sides of the coin, right? Which is, yes, you may see slower growth, and you may see lower real interest rates as a result of it. And there's a bunch of work done kind of around that question. And demographics is a challenge across the board, even in China, where the population growth is slowing materially, and for various reasons, some policy driven, some not. And it's a more pronounced problem in developed markets when you think about the dependency ratios that we'll come to see. The implications. There's a set of implications for asset classes. There's obviously a set of implications for savers as well. The unfortunate message is to save more and save earlier. Which is easy to say, and maybe it's easy to say and not so easy, always so easy to do. But I would struggle with somebody who comes to you and puts forward this idea that there are these, that returns in the future will be just as high as they were in the past. Unfortunately, it's not a few that we really subscribe to.
So I think with the FT today, there was an article about Vanguard opening up a website so that you can buy their life strategy funds for obviously the fund itself charges 22 basis points, that's 0.22% per year, and then you add 17 basis points, so it's only 0.37% per year. So that's going to shake up the fund management industry in a fundamental way, I think. So in that kind of world, how do you see yourself positioned versus Vanguard? I know this is a difficult question.
So look, Vanguard will be a strong competitor. They are obviously an important supplier as well in terms of being providers of ETFs along with other providers in the market. I mean, I think that we all face a variety of challenges. Right? If the fee compression there is good, it's good for consumers. It has affected the fund management industry. It will continue to affect the distribution chain, i.e. from the fund manager to the final retail customer, which is a rather more opaque but very significant cost base that has got a little bit less attention. And I think that's true across the board.
That's right, but the fund managers have been the whipping boy, haven't they? Everybody's
absolutely.
been blaming the fund manager. Look, you're paying you all this money for your active funds, you're not outperforming the index. That's not fair. But we don't think about the next level, which you say, which is from the fund to the end client.
Yes.
So these are.
And I think when we think about where the pools and the fees that we're squeezing, some of it is on the fund management side, obviously with the ETF exposure, but I think increasingly it's going to be a focus around the distribution costs that people have been paying historically and some of the fees there. But as to the specific challenge is the same. You have to provide a really strong product, you have to provide great technology, you have to provide great customer service, and hopefully you have to provide strong investment performance as well. And putting all of those things together will allow you to compete, because you can't, the challenge isn't to compete on any one different part of the platform. The challenge is to provide a complete service to people. And then obviously there's the question about where we are today versus the things that we can try and provide to clients going forward. And there's a pipeline of innovation that hopefully will come forward.
I'd love to know about that when it happens.
We'll be very happy to share it with you when it's released.
But I've got to say, one of the things that does set you apart, in my opinion, is your app. Because I've got lots of questions on the YouTube channel that we run, based on, do you like the app? Is it a useful app? Whereas Vanguard seems to spend very little on marketing. It's a very dry product. Even their term sheets are just monochrome. They don't use colour in any of them. Even iShares tries to put a bit of colour into it to kind of spice it up a bit. So I think that's the hard sell for Vanguard. It's the presentation, but also the user experience is quite low. Look,
I haven't had a chance to see the products. It's hard to comment. What is clear is that the competitive environment in the UK is a very strong one, and hopefully consumers will benefit from that.
Well, anyway, it's been a great pleasure talking to you.
Thank you very much.
Thank you very much for your time.
Thank you.
Hopefully we'll meet again.
I hope so.